Perfect. So now you can see the agenda in front of you. So we'll start by going through the different investment products that we offer here at Saxo Bank, and then we will look at the main differences between the different mutual funds we have on the platform and ETFs, because I think some people might be in a bit of doubt what the actual differences are, even though they might be significant. And then we'll look at the relevance of correlation on your portfolio, and why you should think about this when structuring your portfolio. And then lastly, we will also go through the benefits of diversification and what it actually means. And hopefully, if we have time, which I think we will, I will also go to the platform and then show you some tools there that you can use when having to find ETFs and mutual funds and stocks, and show you these screener tools. So let's move on, and there you go. And of course, we also have to have this brief disclaimer that even though I might go through some specific examples in this webinar, they are just for educational purposes. So please don't consider it advice in any way. Great. So the first product, and probably also the most simple product of them all, is a simple cash product, meaning that could be in the form of a savings account, your everyday account in your own bank. Um, so why would you even consider having a savings account where you keep all your cash at 1% annually if you have the opportunity to invest it? Well, as human beings, we all need to spend money on an ongoing basis to pay our rent, to go on vacation, to do our daily grocery shopping, and that's basically the reason why it's always important to kind of sit down and try and plan how much money will you need in the very near future. Do you have a vacation upcoming? Do you have a rent upcoming? Are you trying to buy a house? And then kind of start from there and see, okay, how much cash do I need right now and over the next month or two? Because of course, if you invested and you need that exact amount in one month, there is a risk that you will not have the same uh, amount of money when investing it. And that's why it's always a good idea to at least have a buffer account in the form of cash. And of course, it's very low risk in the EU. We are also protected by this deposit guarantee of 100k euro, but it's also very low return. I mean, at best, you're maybe able to get 1.5% at your own bank in interest payments, but that'll be it basically. And moving on to the next one, stocks, which I mean, at least we've all heard about it, but what is it actually? So basically, a stock is a small fraction of a company that you buy into, with the hope that this company will perform well, so that its stock price will increase in price, and then you can earn the difference between what you paid for the stock and what other investors are willing to pay you for the stock. So that's one of the benefits that hopefully, and I mean historically over time, stocks will increase in price if you hold on to them long enough. And also, some companies pay out dividends, which you can use as an ongoing income, a cash income, that you can reinvest or that you can pay out as dividend to yourself, basically, and then spend it on vacation, on a car, whatever. Um, and when we talk about the stock market, obviously there are many different stocks that you can choose from. Some people choose to filter by size, so they only look at large cap stocks, which are our usual Microsoft, Apple, Nvidia, all these mega tech companies. Could also be pharmaceutical companies like Novo or Eli Lilly. So it's basically these large companies. Then we have the mid cap and small cap companies, which are obviously smaller companies than the large cap ones. Not necessarily that isn't necessarily worse or better, but it's different kind of ways of characterizing companies and stocks. And then you can also choose to filter stocks based on their style, meaning are they growth stocks? Are they looking into like this hyper growth over the next years, or are they value stocks that just basically keep compounding over the years with a perhaps a smaller increase, but nonetheless a more consistent one. Because that's also what we usually see in these growth stocks versus value stocks, is that value stocks are perhaps a bit less volatile than the growth stocks. But I mean, usually return and kind of risk are you know, it kind of follows the same pattern. So of course, growth stocks, they offer better potential for higher price increases, but they may also be way more volatile, meaning a lot more risk. And then you can also choose to look at stocks based on their sector. If you want to look at technology stuffs, like stocks like Microsoft, Nvidia, Apple, or do you want to look at healthcare stocks like Eli Lilly and Novo Nordisk? You want to focus on financials like the big banks, or perhaps utility company or luxury companies like Louis Vuitton or MS. And then lastly, you can choose to also, so when you structure a portfolio, basically some investors say, okay, I'm closest to my kind of, home country, meaning I have better access to information about domestic stocks versus international stocks. Um, and this is also a kind of perspective to consider, that perhaps if you want to structure the optimal portfolio with the best kind of correlation, the best volatility, then this domestic versus international question is also a good thing to consider. Because instead of investing all your money in, for instance, US stocks or European stocks or Danish stocks, then it's also a way of diversifying to spread it out across markets, basically. Um, and of course, as I also said, when investing in stocks, there's no kind of guarantee that it will pay off, because we've seen, and it's even more important these days, that prices can go up and down, and they can increase 15%. They can also drop 15%. So you kind of have to be prepared to experience this volatility on the markets. And it's especially around earnings. We've seen an increase in the volatility over the last few years, I would say. So before, you might experience these 5 to 10% increases or decreases around earnings. So if they're bad earnings, then we'll probably see a drop in share price. And if they have good earnings, we might see an increase. But it's been, it's pretty evident that over the last few years, this volatility around earnings has increased a lot. So instead of 5 to 10% moves, we now see perhaps 10, 15, 20% even. We saw how Novo Nordisk tanked 20% last week over their bad earnings, or at least bad outlook. So you have to be kind of prepared for this volatility when dealing with stocks. And also, of course, we have the overall kind of systematic the market risk, that naturally, if we see an increase in the interest rates over the next few years, that will, I mean, all else equal, probably have a bad effect on the stock market. And but that's more kind of, a greater economic downturn that's also included in the market, which is it's way more difficult hedging yourself against these market risk, these economic downturns, because that's purely external. I mean, out of your control. Whereas the company specific risks are way easier kind of considering in your strategy, because you're able to actually do something about it if you want to. If you're scared, you can sell your stocks, you can hedge them. But the market risk is just there, and there's not as much to do about it. Then you would have to engage in larger hedging strategies, which is of course possible, but nonetheless also more complex. So moving a bit on, our next product is the bond segment of the market.
Just one
And
quick question,
when we talk about
Magnus.
bonds, we usually divide it into government bonds and corporate bonds. And what we usually see the main difference being here is, of course, the risk, and but also the return, of course. Typically, we see that corporate bonds will have a higher yield to maturity, meaning either in the form of higher coupon rates, or it could also be in the form of being traded at a higher discount, sorry, than government bonds. Because I mean, there is a greater chance that a corporation, a company, will default than a whole country. So that's basically why the risk difference is evident. And when so that's one way of characterizing bonds, government bonds and corporate bonds. And then we also have the bond quality, which is typically characterized by their grade. So we have the investment grades, which are the bonds that are viewed as being, safer than the high yield ones, meaning their credit rating from the big credit rating institutions like S&P or Moody's will be better than the high yield ones. And basically, what this what this rating tells us is the probability of default behind the company or the government or the country that issues these bonds. Because basically, a bond is just a loan that you as an investor give to a company or to a country. And therefore, of course, there is a risk that, okay, this company is not able to pay back my loan. And that's what we call the risk of default. And from these bonds, you are able to, and that I would actually say that is one of the big benefits of the bonds, is that you know exactly how much you will earn on the bond if you hold it to maturity, and of course, if the underlying issuer does not default, because you have a set coupon rate which does not change. Meaning, if you find a bond where it says, for instance, 2% in the name of the bond, that means there is a 2% coupon rate on this. And this coupon rate is paid out either quarterly, it could be half yearly, it could be yearly. So the coupon rate is always expressed as an annual coupon rate. Meaning, if you have a coupon rate of 2% and you have half yearly coupon payments, then you'll get 1% each time. But that is a cash payment that you will receive as a kind of thank you for the loan that you have given this company or country. So you know that you will have this consistent income stream because of the coupon payments. And then also, depending on the bond quality, you will also find that some bonds are actually traded at a discount. Meaning, if they have a face value of 100, meaning when the bond reaches expiration, it will be paid back at 100 a unit. It could also be 1,000 for that matter. But if you find if you find a bond that is traded at, let's say, 90, that means that this bond is traded at a discount, and that's not necessarily due to its quality, but it could also be that some of these long-term bonds that we have that with expiration in 30 years or 40 years, they will have to kind of have an extra upside besides the coupon payment, namely the actual price increase that you will also earn money for. And then some investors choose to also speculate in bonds, saying, okay, I anticipate that the interest rates will start falling. Therefore, I buy this bond at a discount at 90 a unit. And then when the interest rate starts decreasing, I know that the bond price will increase, and therefore they are able to kind of earn the difference between the purchasing price and the selling price. But at least if you hold the bond until maturity, you are 100% sure what you will get out of it if the underlying institution does not default. Namely, the difference between your purchasing price, the face value, which is often 100, and the coupon payments that will be paid out at the specified frequency.
Magnus, can you hear
Yeah,
me
and the
now?
risk I already explained that we have this interest rate risk that if the interest rates in the economy starts increasing, we will usually see the bond prices starting to fall, because they will have to compensate for the higher interest rate that you could get at your own bank, and therefore the prices fall, so that new investors will get a higher effective annual rate of return. And there is also the credit risk, namely that the issuer cannot pay you back, basically. So those are the two things that you have to consider and plan for. And usually with bonds, we always say that the bonds with a longer duration, meaning let's say they expire in 20, 30, 40 years, whatever, they're more sensitive to these interest rate changes than the ones that expire in, let's say, 1 year, 5 years. So the duration kind of is a good way to determine the interest rate risk in this bond. So that's a good thing to note. Moving on, we have the mutual funds. So a mutual fund is basically a fund that you, as an investor, buy into. You tell a portfolio manager somewhere, it could be in a financial institution, it could be in a hedge fund kind of setup. That's okay. I trust you with my money. I know that you will survey this portfolio. You will manage it actively, and you're obviously more professional than I am. So you take my money and you just find the best investments for me. So a mutual fund will often be actively managed, meaning you do have a portfolio manager behind the mutual fund, actually surveying it and doing the necessary kind of changes in the portfolio. And then hopefully you will make money from the fund value increasing. And also some of these funds pay out dividends as well. Some are accumulating, meaning that instead of paying out the dividend, they will just reinvest the dividend that you were supposed to get. So that's also one one thing to be aware of, that some of them pay out dividends and some don't. So if you prefer having this consistent income stream in the form of dividends, be aware that some of them do not pay it out but reinvest it. And I mean, it's a very kind of personal matter whether you prefer the one or the other. I would say. And some things to also be aware of besides that is that, and I will touch upon this, in contradiction to ETFs, stocks, these mutual funds are priced once daily at their net asset value, meaning the values of the stocks that or bonds that they hold, and minus their liabilities, meaning the expenses that you pay, divided by the total number of outstanding units. So instead of being able to see a live price on the mutual fund at all times, like you can if you trade a stock or if you trade an ETF, you'll get one price per day at the end of the day, this net asset value price. So it's a bit less flexible, I would say that than ETFs, because it's you basically don't know what it will end at, and usually they're also less transparent than ETFs, which I'll also touch upon later. So and then one key thing to be aware of is that you will often notice that these mutual funds, they have way higher fees, I would actually say, than the ETFs, because they are actively managed instead of just following a passive index like the ETFs. And I mean, of course, if the portfolio manager, if the mutual fund can also provide a better return than the passively managed ones, then I mean, it does make sense to pay a higher fee for it. But it's not always the case. And the ETF product has also become way more popular, so the fees on ETFs are way lower. So that's a good thing to kind of be aware of when you choose whether to invest in a mutual fund or in an ETF. And with that being said, let's move on to the ETF product. Yeah, and I just forgot to mention that of course you can find mutual funds focusing on specific sectors and specific regions. Could also be a global kind of mutual fund. So that's basically in that sense you have a lot of flexibility. And then the portfolio manager behind this mutual fund will focus on stocks that have exposure to the theme or the sector that it's advertised to invest in. And that's basically the same with the ETFs. That you can find ETFs covering different stock markets based on geography. Could also be based on sectors, industries, or like themes as a general. You can also find ETFs, and that's perhaps even more relevant to mention these days, that cover or follow the price movement in commodities such as silver or gold. So instead of having to trade silver and gold on margin, which a lot of the products are, the spot products on these commodities are, you can just buy an ETF that basically replicate or mirror the exact percentage increases or decreases in the underlying commodity. So that's a very easy and a very transparent way to get exposure to commodities, I would also say. And yeah, as I just said, benefits of choosing an ETF over a mutual
Magnus?
fund is that the costs are way lower usually than mutual funds. I mean, if you find some of these big providers of ETFs from BlackRock that have the iShares ones, could be Vanguard, could be Wisdom Tree, whatever. You'll see that the costs are very low. Sometimes it's all the way down to 0.1%, 0.2% in annual fees. And it's a very transparent product in the sense that you can always, with publicly available information, find the specific index that this ETF is tracking. All right. So when you invest in an ETF, that ETF is always tied up to a passive index consisting of a set number of companies, basically. And that index you can always find by just searching for the ETF on Google. I do that myself when I have to find information on it. I think we also, for most ETFs, have the top 10 holdings in the index that it's tracking. So it's very easy and very quickly to find the actual holdings of this ETF, so that you can consider say okay, let's say you don't want to invest in a specific kind of sector, then you can quickly. I mean, of course, it will also make sense to not find an ETF covering that sector, but nevertheless, you can always see the largest holdings in this ETF, which I mean, of course, is nice to know what you are actually investing in, the underlying exposures. And yeah, I mean, it's traded in normal market hours, so it's very easy access. And perhaps the key benefit, number one key benefit of an ETF, is that you just get a very large and broad diversification with just one investment. So instead of having to find 10, 20, 30 stocks yourself, maybe even 50, 100, then you can just buy one ETF that covers all of them at once. I mean, of course, within the natural boundaries of what's possible. But let's say you believe in the future of AI, then you can find an ETF covering maybe the 100 largest AI companies in the world. So instead of having to do all the investing yourself, you can just invest in one ETF covering all of these at once. So it's super easy, and it's a great way to say, okay, let's say you're not comfortable trading that much. Perhaps you don't have the necessary time or the necessary information to do so. Put it in an ETF, and then it will basically kind of handle itself over the years. And then hopefully, when you look again in 10 or 20 years, it will have increased in price historically. So, and also some ETF pay dividends, some don't. Also a thing to be aware of. And I mean, the risks are basically the same as, I would say, stocks, in the sense that given that you follow indices that are consisting of stocks, then naturally, if these stocks decline in price, your ETF will also decline with the respective weight of the decrease. Sorry. Yeah, and also, I mean, given that the popularity of ETFs have risen very rapidly over the last few years, I would say, some ETFs have also started to become very, very specific, very niche, which usually means a bit higher costs. And also, sometimes when you look into the actual holdings of this very niche ETF focusing on miners in Africa that have exposure to, or that mines, some very specific precious metals, for instance, the companies may actually not be that good. And given that you invest in the ETF, that then you will also have exposure to these underlying companies. So that's also one thing to be aware of, that even though you have like this product, this ETF, it's completely tied up to the performance and thereby to the economy and to the financials of the underlying companies. So if you find an ETF where 80% of the companies actually are not very good companies, in the sense of their, like based on the fundamentals, then your ETF will also have exposure to these bad companies. So that's definitely a thing to be aware of. And lastly, you have the currency exposure. So let's say you find an S&P 500 ETF traded on a European exchange, you might think, okay, I don't want to buy anything in dollars because of the recent decline, so I'll just buy this ETF in Europe, and then I still have exposure to S&P 500, the American index. Well, then, unless you find an ETF that is actually euro hedged, you will still have the underlying exposure to the dollar over the euro. So that's also one thing to be aware of, that even though you might buy it in euros, the companies, if they are from the US or from Asia, whatever, then you will still have that underlying currency exposure to the given currency that it's that the companies are traded in. So be aware of that. And if you completely want to take out the currency exposure perspective, then some ETFs are indeed euro hedged, for instance. So it should be possible to find such. Great. So if we should sum up these differences between mutual funds and ETFs, I've tried kind of summarizing it here in terms of the trading hours. So ETFs, you are able to trade all day, whereas mutual funds are only priced at the end of the day in net asset value. The management, in terms of the underlying exposure, is actively managed in mutual funds and passive in ETFs, meaning you have less kind of, surveillance of the actual holdings in the ETF. But I mean, if you just want to have exposure to like the S&P 500 index or the MSCI World Index, then usually it's not necessarily kind of necessary to have this kind of underlying surveillance from a portfolio manager. And also in terms of the transparency, as I touched upon, ETFs are usually easier to find some actual information on, to see what's actually in the index that it's tracking. Whereas the mutual funds might be a bit more difficult. Maybe they specify, okay, we will focus on companies that fulfill these criteria, but then don't necessarily show the companies that they have invested in. And then you're kind of, investing not in the blind because you have people watching over it, but you get me. And also in terms of the minimum investment for an ETF, if an ETF is traded at 100 euros, then that's the minimum investment to buy one. Whereas mutual funds might have some criteria to the minimum investments, and I've seen some even having minimum investments of up to 100k euros. So in that sense, ETFs are also way more flexible, I would say. Yeah, and then mutual funds are popular for people wanting to actually have active strategies, and ETFs are perhaps better suited for the ones that are less focused on short-term volatility, but is more focusing on this long-term perspective. Yeah. So moving on, I figured it was also relevant to touch upon the aspect of correlation in your portfolio. So basically what correlation means is that if you find a lot of stocks within, for instance, the same industry, let's say you invest in Microsoft, you invest in Apple, you invest in Nvidia, then those three stocks will they will basically be perfectly correlated, meaning if some of them experience a downturn that are not company specific, but more like sector specific, then you can be more or less sure that other similar tech companies will experience the same. So that's a positive correlation, meaning your stocks in the portfolio will move somewhat the same. I mean, naturally, you can have some company-specific events like earnings, like scandals, whatever, that can affect them differently. But in terms of correlation, you will have somewhat the same price movements. And also the other way around, if you have negative correlations, you will have assets that move in opposite directions, which you can also see in the small table below. What we have seen for many years is that stocks and bonds, they have a low to even negative correlation, meaning if stocks experience a downturn, then bonds can kind of stabilize because they're not as exposed to these very volatile movements, these large movements, where they're way more stable because I mean it's a bond, so you have a set coupon. You know that okay, unless the underlying company will default, they will be issued, or they will be repaid at the face value. And we've also seen this kind of tendency with stocks and gold, that usually when stocks have experienced a downturn, investors have viewed gold as kind of a safe haven asset to kind of place their money in if everything is falling apart around them. Um, One could argue that gold has become a bit of a speculative asset these days, but nonetheless, I think it's still relevant to say that, or it's still possible to infer that they have a low correlation. And I mean, why would you even care about this? Well, you would care about correlation if you kind of want to be very sure that your portfolio doesn't experience these large movements. Because structuring a portfolio with the objective of having as low a correlation as possible means that, yes, perhaps you will have a smaller return, but in the event of downturns like we've seen in the past, in 2022 during the COVID, and before that as well, if you have a portfolio with low correlation, then maybe if the tech sector experiences a huge downturn, but you've also managed to include some pharma companies, some utility companies, some real estate companies in your portfolio, then the volatility in your portfolio might be less severe, because these other industries, which are, let's say, low correlated to tech, just for instance, and then they will perhaps be a bit more stable and a bit more, maybe even increase. So the idea is to kind of have some that will move in the other direction, or perhaps be status quo if other assets perform bad. Um, so that's the whole idea of having this correlation aspect in your mind when structuring your portfolio. Um, and it's also a bit, I would argue, connected to the aspect of diversification, which basically means that you focus on spreading your investment out. That could be in terms of geography, could be in terms of sectors, could be in terms of investment styles, growth versus value. So basically focusing on structuring your portfolio in a sense so that you don't put everything in one sector, or everything in one region, or everything in one kind of stock, growth stocks, for instance, but instead try to kind of balance the things. So have some in tech, have some in pharma, have some in real estate, whatever it might be, so that everything is kind of, stabilizing itself if one industry is experiencing a downturn. And you know, an argument is that's also on the screen right now. Why diversify? Because if one company, let's say Nvidia's next earnings are looking very poorly, then if you had placed all your money in Nvidia, then of course your portfolio, your total wealth in that portfolio would decrease with the same amount of this decrease in Nvidia stocks, for instance. Whereas if you had this kind of diversification in your portfolio, you would instead, of course, experience a downturn on your Nvidia stocks, but then maybe some of your other stocks in other sectors would perform better. And then it would kind of, stabilize so that you don't lose 20% of your value in one day. Naturally, it can also lead to, smaller returns, but nonetheless, I mean, it's all about the risk-adjusted returns that you have to consider. That how much return will you get for each unit of kind of risk or volatility that you add to the portfolio. um, and that can be kind of mitigated through diversifying your portfolio, I would say. And that's exactly one of the key benefits of ETFs, that you get this natural diversification effect, given that you have one ETF, it's one product, one time that you have to press buy, but then that one purchase will lead to a small investment in maybe 100 companies or 1,000 companies even. So that's kind of a natural way of spreading out the risk through these ETFs, so that you don't have to kind of find 50 or 100 different companies yourself and then invest in it through regular stocks. Um, I've tried also kind of showing this kind of effect of diversification in the small graph, where you can see that the larger the number of shares, the lower the number of portfolio risk. And then you have kind of, a bottom line in terms of the market risk, which is which is more difficult to diversify away, I would say. Um, but I hope you get the idea that it's basically all about, stabilizing and kind of, making sure that your portfolio volatility is not completely out of hand, because a lot of investors, I would argue, one of a lot of investors' biggest concern is seeing these huge decreases in their portfolio value, and then they panic, and then that leads to a spiraling effect on the whole market. And that's, one way of kind of mitigating that is just spreading out your risk, basically. That's probably the best advice anyone can give someone that's about to make their first investment. Because I mean, we all have to be able to sleep at night, right? And diversification can definitely help with that. Great. I think I
Sorry,
might have
one
talked
quick
a bit
question. I don't
quickly,
know.
but yeah. Nevertheless, I think we should move to the platform now, because I just
Yes,
wanted to show you a few tools. Um,
Mike. This,
oh, sorry.
Mike. This just one
Oh,
thing.
sorry. Yeah,
Uh,
yeah. I
Can
cannot hear you.
people just write in the chat if they can hear me? It seems like Marcus and I cannot hear each other. But if in the audience you can hear me, can you just write yes or no so I have an idea of what's going on, please? And then Magnus is going to go to the platform. Okay, so people can hear me. That's great. Magnus, you have the floor again if you can go to the platform.
Okay, I think that was my cue to talk again. Yeah. Perfect. Okay. So before we start taking any of the questions that you have asked, which we will of course have time for, I just wanted to spend 5 minutes on the platform to show you some of the great tools we have there in terms of, I think one of the main questions I'm asked when I speak with clients on a daily basis is, so how do I get started? I mean, this is a completely new area for me. I mean, I know Novo Nordisk, I know Nvidia, but that's only because I've heard it about a few times now. So how do I get started? How do I find some of these maybe thoughts I've already created in my mind? How do I get it to actually be executable? Um, we have made a few tools on the platform to kind of help you with that, which I just wanted to show you. So if we go to the platform, yeah, I hope you are able to see my screen now, my SaxoTrader. I'm sorry if any of you are preferring Saxo Investor. I think I just figured I wanted to go through it here, as I think the screener tool is a bit easier finding on the SaxoTrader, to be honest. So basically, if we go to this screener tool up here, you will be able to add these filters depending on whether you want to see we can just start with ETFs. So let's say you've kind of made some initial thoughts to your strategy, to your investment plan, but you are not able how to find these ETFs that will kind of get the exposure that you want. Then you can go to this screener tool. You can put in ETFs here. Then you might have made a plan saying, okay, I want to focus on what have we? Yeah, let's say global equity large cap. So that's just like large cap companies on a global basis, yeah. And then you only want to see ETFs traded in euro. Um, yeah, let's just say that's the initial thoughts you've done. But I mean, as you can see, you have multiple different kind of criteria that you can add. You can add these ratings, these sustainability ratings. Perhaps you have a favorite issuer that you only want to see funds from. So all of these kind of criteria you can just add based on the things that you have considered in your investment plan. Then you can press done. Then you will see all the different ETFs that have the exact exposure you have put in here, meaning all the ETFs that have an exposure to some global equity large cap stocks and that are traded in euros. They will be visible here. And I mean, of course, there's still a lot to choose from here. But some things that you can be aware of, or at least look for, is first of all, okay, what are the costs? So here you have the ongoing costs. This one is 0.12%, so that's actually a very low cost. Then you might see one that has 0.2%, 0.3%, whatever, and then you can, based on that, if you are very, cost aware, then you can choose that as a criteria once you have done this list. And in the same sense, we also have this profile where you can see the top holdings. So this one, for instance, MSCI All Country World, has 4% Nvidia, 4% Apple, 3% Microsoft, whatever. So there you can see all the top holdings basically. We also have made this asset classes. Of course, it's equity, sector, tech is 26%, finance is 20%, and so on. And also here. So these kind of insights that we have made on the platform is actually very useful. Instead of you having to do this kind of research yourself on Google, then you will find most of it here at least. There's also this key information document. We try to open it, where you can also read something about the fund. Yeah, I mean this is perhaps a bit too detailed, but nonetheless it's possible. Great. And I mean, in the same sense, you can do it for stocks. Well, you will also get some different criteria. These are the descriptive ones. Then you have some fundamentals. You have some technicals, whatever you might want to focus on. Let's say you are very focused on finding stocks that actually pay a dividend yield. Then you can also add that here. Let's say you are doing some fundamental research on the company's kind of financials. Then you can also add the PE ratio here. And with bonds, where is that? Where is bonds? Here. We have also added that you can search for, government or corporate bonds. Let's say you have calculated that you will at least need 2 or 3% in coupon a year. Then you can also add that. You can have the mid-yield to maturity, so the combined kind of effective annual rate of return until maturity. That's the one here. Let's say you only want to focus on bonds with a long time until expiry, then you can add that as well. And also the S&P ratings down here. So these are the ones that I spoke about when we talked about investment grade versus high yield. And I think until I'm pretty sure it's until BB minus, that's investment grade. And then these will be high yield, and the farther down you go, the more junk bonds it will be. Also, perhaps with a higher yield to maturity as well. But yeah, so basically you can have all these search criteria, and in the same sense as for ETFs, you get the complete list here with the bonds that fulfill your criteria. You'll have the last traded price, the bid price. I'm sure we also have something more here. Mid yield to maturity, coupon, maturity. So I think this screener tool is such a genius way of finding things that you may not be able to. I mean, after all, our platform has like 70K different instruments, so it might be difficult finding some of the things that you want to find if you just use this instrument search. And then, I mean, if that's the case, then definitely try and check out this screener tool. And then, I mean, we have also made some on our research page here. We have tried to gather some different markets here, themes. See all these themes here. Let's say you want to see defense companies, then you go to the defense theme, and then you can see some of these stocks that have an exposure to defense. So, I mean, I would say we've tried gathering as much kind of inspiration and information as possible on the platform. So instead of spending a lot of time searching for it yourself in Google, maybe try and check out the platform first. It should be something for everyone, I would say. Yeah, so if we also want to have some time for questions, I think we should do that now. I cannot. Yeah. Okay, so first question, what do you mean they are bought and sold once per day? I think you're referring to mutual funds here. Well, basically what that means is that when you have an ETF that's traded on an exchange that follows companies and stocks, also following normal trading hours, you will always have like an updated price on the ETF. Whereas with mutual funds, the fund behind the mutual fund will do like an end of day evaluation of saying, okay, today we've had these holdings. Today these holdings have kind of performed this and this. So our net asset value of this fund is this price, and then that's the price that you are able to sell or buy for once a day. So that's basically yeah the meaning behind that, the fact that they are only priced once daily, the mutual funds. That's also why we say that they are less transparent and less flexible than ETFs. I hope that's answered it. Would there be appreciable difference between ETFs of Vanguard or UBS or any other provider? I mean, it's difficult to say. I would probably say, I mean, given that it's an ETF, these providers probably follow somewhat the same index. So in terms of the holdings, no. If you find a world ETF from UBS or Vanguard, then the holdings of that ETF would probably be the same. But maybe the costs are different. They usually are. But there's not like one single answer as to, okay, the ones from UBS is not good and those from Vanguard are better. It depends. And it also depends on what you focus on. If it's cost, then you can, of course, try and check the costs for each provider and each ETF.
Yeah, there shouldn't be much difference, as Magnus is saying. If they follow the same index, you should look at the liquidity, the volume, the number of shares sold, and then the cost, of course. And then we're going to go to the next question. Here we go.
Okay, one more question.
Actually, I
So
think I can
with
answer
ETF,
that
who
one.
owns the shares comprising the ETF? For example, if Vanguard were ever to go bankrupt, can my invested funds to be used to serve the creditors of the ETF provider? I mean, with the fear of saying something wrong in terms of the the case of bankruptcy of the provider, I would say this is probably best found in the key information document of the ETF. That there they will definitely have explained the kind of the rights for you as an investor in the case of bankruptcy. But yeah, Ida.
I think I actually can answer that one. I mean, the ETF is a separate legal entity. It's separate from the asset of the provider, so you're fine. Even if the provider goes bankrupt, Vanguard, your shares are safe. So we're going to move to the next question.
Okay, so when we invest in a bond fund, is it a mix of different bonds? How exactly do we buy bonds in your platform? Yeah, so basically, if you have a mutual fund or an ETF tracking bonds, so it's called a bond ETF or bond mutual fund, that ETF or fund will be comprised of a set of different bonds. Let's say, for instance, you find an iShares 3 to 7 year EU government bonds. Then yes, that bond ETF will be comprised of, let's say, 5, 10, 20 different government bonds from the EU area, all with a duration of 3 to 7 years. But the thing is that sometimes these bond ETFs can be a less bit transparent than if you buy the kind of single bonds yourself. It's not always as transparent exactly what the coupon rate will be on the bond ETF or what the dividend will be. But yeah, to answer it simple and surely it will be comprised of different bonds. Do you have some managed portfolio with high balance, low risk versions? So Saxo does not offer any actively managed portfolios ourselves. We also don't have any ETFs or anything. So we only kind of facilitate the trading of other providers, ETFs or funds. But I mean, yeah.
Yeah, we do not manage funds, but on the platform you can find funds. Actually, using the screener that Magnus just showed, you can search in the search function for balanced, conservative, or low. If you just type that, and then you get a list of funds, both mutual funds or ETFs that are balanced. We do not manage those funds, but we provide those from other providers. And we have one more question for you, Magnus.
So why not just invest in a single world ETF, maximum diversity? Yeah, well, I mean that's you've definitely listened to what I said. So yeah, I mean some investors also choose to do so because I mean a lot of the people that I talk to, they have no interest, they have no knowledge of the stock market in general. So they ask me, you know, what's the broadest index that you can find, and that is the world index. And then they're like, okay, well then I will follow the markets in good times and in bad times, but I will have the broadest exposure as possible. And that would be yes, that would be the answer. So it's not necessarily a bad strategy doing what you did. Sometimes it's also not about overcomplicating things, but it all depends on. I mean, we all have different kind of investment strategies. Some people deliberately choose to focus perhaps a bit more on a specific sector or a specific region, and in that case, the world ETF might not be the best choice. And you also have to be aware of the fact that even though it's called a world ETF, then because of the recent years increase we've seen in the US stock market, that world index that one might think is, you know, comprised of an equal exposure to all regions is actually 60 or 70% the US. So that's one thing to keep in mind, that even though you think it's a world ETF, 60 or 70% of the exposure will be in the US anyways. So if you want to have an equally weighted world ETF, meaning you have 20% in the US, 20% in the EU, 20% in whatever Australia, Asia, then there are also some providers that actually do this kind of, you know, rebalancing all the time, so that you can have this equally weighted world ETF. Yeah.
Okay, next question from Simona.
Do I have a field of ETFs I can buy with my ask? That's a good question. To be honest, I'm not sure we have done so. I'm not 100% sure of that one, but I mean, when you're on your ask, if you try to buy a certain ETF, it will always show you which kind of, you know, accounts you would be able to buy that ETF from. So obviously, if your Aktiesparkonto is not a part of those choices, then you would not be able to buy it. But we haven't made a filtered list. I would say my best guess is that there are perhaps 10,000 different ETFs that you're able to buy. So it would also be a bit of a comprehensive exercise to do. So.
And I think for this, maybe you can contact our customer service. They might be able to help you with this type of question. And it is the same for a question that we have from Ed regarding structured products. I would suggest you contact customer service, and they'll be able to provide you with an answer to that question. I think we have time for one last question. I just had it there. Here.
Okay. Do you recommend a mixed basket of all stocks, bonds, and ETFs, or better to focus on one? I mean, it completely depends on what you want to achieve with your investments. If you want to achieve really high growth and you're ready to take on some risk, then I probably wouldn't focus on bonds, because bonds are supposed to kind of, you know, be a bit more stabilizing, but also with lower risk and lower return. If you want to have a very balanced portfolio and you know, a slowly, steady and consistently growing one, then yes, you could argue that the mix of stocks and bonds would be the way to go. But I mean, stocks and in ETFs are basically the same, at least if you find some ETFs that have exposure to stocks. So unless you have like these very darling companies that you believe a bit more in than the rest, then in terms of the stock exposure, then ETF should be sufficient. And then one can choose to also add some bonds in terms of getting some stabilizing effect on their portfolio and some kind of consistent income stream in terms of the coupon rates that are paid out. So I would say it depends on your investment strategy. There's no single right answer to it. It all depends on your horizon. It depends on your kind of your needs. Do you need this steady income stream in terms of coupon rates? And then of course your risk appetite. Will you freak out if your portfolio drops 20%? If yes, then perhaps not put everything into a tech basket. But if you're young, if you think, okay, I'll need this money in 50 years, so whatever happens on a short-term horizon, then one might be a bit more inclined to focus a bit more on stocks than bonds. But it all depends. We are all different. We all have different goals and needs. So that would be my best answer to that one.
All right, I guess I just want to say sorry for the technical issues with the sound. Magnus and I could not hear each other, and at the beginning you could not hear me, so apologies for that. I just wanted to say that the slides are available in the room for our download, and the recording will be available tomorrow on the platform and the website. So again, just thank you for joining us today. Hope to see you at future events, and thank you, Magnus. Thank you for your help. Thank you for taking time with us today. Have a good day, everyone. Bye.
Bye bye. Thank you.